Hey everybody, Mark Kwan back with the perfect portfolio where we want to basically want to sit on the beach behind me right there. We want to collect income, huge income streams, and we also don't want to pay taxes. So we obviously for the people who are kind of new to our channel here, we teach a very unique strategy which is not really taught in the financial industry called buy, borrow, die, where we buy portfolios. We never sell them. We constantly reinvest those dividends for the rest of our life. And the only way we retire is exactly the way that billionaires do, is just basically borrow, because borrowing is tax-free and working hard is highly taxed. So on that note, we started the perfect portfolio with the idea of building income streams. We wanted to build automated income streams where we don't have to work, right? We can work because we want to, but we don't have to work. And 2.5 years ago, we started building this thing called the perfect portfolio, and we were borrowing at 2% interest at the time when rates are low, and we were basically collecting 12% income streams on different covered calls, which if a lot of people don't, some people understand what covered calls are. And then during this course, we ran across these Jay Pestrichelli, who's been on our channel before. We had him on here, and we talked about the innovation in the options market, right? And I love options. I'm a huge options geek, and we're just talking about it. And so I was talking to Jay the other day, and Jay said, "Hey, we have some innovative things coming in the pipeline." And so we just had an opportunity. We finally got our schedules together and got them on the channel. Now, first of all, this is not financial advice. I'm not your financial advisor, right? But this is an opportunity to raise your financial IQ. So we just want to welcome Jay to our channel. And good to have you back again. And what's new in your world? What are you excited about? What's your next mountain you want to conquer?
Thanks for having me, Mark. Yes, it's great. We finally got our schedules lined up, and appreciate, as always, the support and interest in what strategies we're managing here at Zega. So I think there's probably two new ones since the last time that we talked about that maybe we could touch base on. The first one is THTA. We call it theta. For those option nerds out there, that yes. Theta is the Greek that represents the time decay that you get in options, right? And so the strategy, as aptly named in the ticker, THTA, is designed to kind of earn the natural time decay of options. So the strategy itself was built over kind of a basket of treasuries, and then we sell options that that are far out of the money, that have all of their returns are going to be generated just by the natural passage of time. Mark, I say this kind of tongue in cheek, but the only thing I guarantee on Wall Street that happens is that tomorrow comes after today. And if I can make money on that, that's the concept of theta, where we're earning theta in that portfolio.
You're essentially selling time for people who don't understand options, right? That's really the selling time.
The nitty gritty of that strategy is where like you said, we're selling time. We're selling option spreads on the indexes like the S&P 500, and they're put in such a way that they are what we know is what we call far out of the money, meaning they're very far away from the market, which means the ebbs and flows of the market typically don't have much of an impact. Of course, you have big moves in the market that can impact the fund, but generally speaking, markets don't move 10% in 2 weeks, right? Those are that happens, but it's rare, and this strategy benefits from that not happening. It's weird. It works because something doesn't occur. That's the way out of the money options work.
Okay, so maybe we can bring this back to the people who, first of all, you have your basic covered call, right? Typically, somebody would put money in an index fund, traditionally like a QYLD or something, and they would put it actually in the index, and then they would sell a call option once a month. I think that's traditionally how they've been done. It's just very systematic. Once a month, you sell the call. How do you try and simplify what this is, what theta is? Any ideas on how is this different from a typical?
Yeah, so by the way, cover calls, you're right. You are selling options, and the primary driver of return are the premium you earn from the option decaying away. Similar concept here, right? When you're a seller of options, you want the option to go down, right? You want it to expire worthless, right? You sold something for $2, and hopefully at the end of it, you don't have to pay to get it, to buy it back, right? It's worthless. You're out. You keep the $2. That's generally how option selling works. So with this scenario, you're right. The covered call is you're kind of bullish on the market. You take market risk if it drops. Well, you have market risk in any strategy. This is not a market neutral strategy, but the chances of it occurring are very low. So if you were to, let me give you an example. Think about this as we are, for lack of a better term, selling lottery tickets, right? And so the chance of you, Mark, hitting the lottery is really low. The dollar you paid me for that lottery ticket is what, the strategy is earning. The chance of the, unlikely to occur goes to our benefit, right? So selling those is, as Robbie, I hate using lottery tickets when it comes to investing because this is not a lottery ticket, right? Everything's well defined. But my point is the chance of this strategy running into trouble generally, based on where we put these on, is only about 1%. So when we look at the risk of the strategy and we look at the return of the strategy, I always like having an advantage where I'm getting a little more return from the risk that I'm taking. So for example, a trade that we might have put on not so long ago, we put on a trade that had a 99% chance of working, which means it has a 1% chance of not working. Well, I want to get paid at least 1% in that 1 month period that this trade is on for that position. So if I can get one or more, great. Now I've got kind of an advantageous ratio of risk to reward. And that's how the strategy works. It aims to kind of sell options, that generate somewhere between 1 to 1.5% a month. That's the target. And it's done over a basket of treasuries. So we get a little juice from yield these days as well.
Okay. Again, similar strategy. It's actually in treasuries, and then you're selling options on the treasuries, which would be somewhat similar to other things you've designed, other positions you've designed.
Yes, absolutely. The treasuries act as collateral for the option requirement, right? You can't just do it willy-nilly. There needs to be some collateral when you sell options, right? So yes, we sell it over a basket of treasuries. That's correct.
Okay, so just summarize, you have a 90 in this trade you start talking about, you had a 99% chance of being right, and you could make 1%. Is that right?
You got it. That's kind of the way, that's the simple math on this. Yep. That's right.
Okay, good. And from my understanding, this is not a new strategy. This is not something you're like, oh, we're going to try this out. This has been around. Was that a Zega product that was you were working before you designed the ETF, or what's the
so our partners at SoFi, this is a SoFi sponsored ETF, THTA, and but before that, you're right, we do have kind of we'd say a separately managed account that runs in a very, 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 very similar fashion that there is a longer history on. We've been doing that really since Zega's been around for the 13, 14 years. We've been running this type of a strategy where we're selling those options that have a high probability of success for this, small amount, but you do it over time. That's right, and that's how this has been built. And the connection to the two strategies is very tight.
Awesome. Okay, good. So just like how is that the TSLY? I know there's been lots of comments about TSLY erosion and things like that. Does any changes in the TSLY, how it's managed or anything like that since it came out?
Yeah, so switching over to YieldMax, right? TSLY itself, right? The option strategy where we're selling weekly calls against the underlying ticker, like Tesla itself. Yeah, so look, it's a good question, right? We get it all the time. I would say we don't like to use the term NAV erosion. I mean, it's a bad term, period. So nobody would like to use it, but that is usually a characteristic of a leveraged fund, right? But the YieldMax funds are not leveraged. They don't use any leverage. They just have 1x notional. So what that means is, but the question is ultimately, hey, why is the NAV dropping on YieldMax? Well, remember, YieldMax runs a covered call tactic. And the characteristic of a covered call tactic is you're going to get paid some option premium for giving up some of the upside of the underlying stock. So when you look at Tesla, for example, that has had a very, I'll say an EKG for a chart this year, right? Multiple times of spiking and dropping. In those scenarios, the return profile of any covered call strategy is, because we're limiting our upside, we only get some of the upside, but you get all the downside, right? So when you have a stock that does this, a covered call strategy will do this, down, but a little less up, down, a little less up. And so the decline in the underlying NAV is of, you know, the TSLY NAV is due to the option tactic itself. It's just a characteristic of a covered call. But that's why you get the high yield, right? We're getting paid for taking, you know, taking that risk off. And so, you know, again, it's one of those things we don't always like to compare TSLY to TSLA because they're two different strategies. If you're bullish Tesla, just own Tesla. But if you're looking for high yield and alternative income, then TSLY is a different strategy.
Right, definitely, for sure, for sure. And now I just, and here's why I'm asking about this, is that I want to know the good and the bad. I want to find out, or well, not even the, I wouldn't say the bad for the one, but
you need to know what to expect. You need to know
absolutely
exactly
expectations, right? If you want to go gangbusters, go buy Tesla stock, right? If you want to, you know, get some income there. But yeah, I did some analysis before our meeting, and I was looking at it. So Tesla at the end, if you went from it when it came out, and I use a portfolio visualizer, so we only went until the end of the year. Tesla stock was up 100%. TSLY was up 50%. Not a bad year. I mean, I got to say that's pretty cool. The S&P 500 was up 26%. Okay, cool. Then we had NVDY was up 31%. And that was since June, where NVDY was only up 24%. Not bad since June. September, I'm a big fan of big fan of cryptocurrency, so I was a big fan of CONY. And I've been loving the ride up on that one. And Coinbase is up 119, where CONY was up 79%. So and you have Amazon and Facebook or Meta actually beat the synthetic cover calls. AMZY actually beat Amazon, and Facebook FBY beat Meta about 17% for Facebook. FBY and 11% for Meta. So you're getting sort of the opposite in range. You're also getting some periods where the for the synthetic cover calls are actually beating the stock. So did you expect that? Did you see that? Did you know that was possible? Or is that just the range of, you know, of how these things are managed? Or is it a factor of the volatility?
Okay, so it's a factor. By the way, thank you for pointing all of those out. Appreciate it. I would say appreciate the math that you did for us. I would say, look, it's a factor of the underlying stock, how it behaves. So, again, first off, it's great to hear that, right? We have this kind of total return, despite what the price of the ETF may do. The total return is still positive. That's actually first thing that's really important. Okay, we're making money because we held these. That's great. The second thing is, hey, how come, to answer your question, how come sometimes you're beating the underlying, sometimes you don't? It's think about the way that Meta looked, or Google looked in their charts, or even NVIDIA looked, right? Those are fairly stable on the way up, right? Where you look at a Tesla, it's been doing the EKG, the heart monitor chart, which is not our favorite.
Right.
Covered call strategies perform better in an environment when the underlying is up and it moves up in a more muted way, where it doesn't go through our strikes all that often on the covered call strategy. And so the more volatile, the farther away we'll be on our calls, like CONY, for example, right? The calls that we sell in those portfolios, because there's more volatility, we can capture more of the upside, which is why we're able to capture so much of that move. But, you know, generally speaking, it's a symptom of the underlying ticker. And I would say, look, over time, covered call strategies on, you know, highly volatile stocks will pay you plenty of premium, but you don't really want to compare them to the underlying, because if you want the underlying, just on the underlying. But if you look at a more stable, like a Disney or an Apple, or, you know, Google or Meta, in those scenarios, the covered call strategy absolutely can be constructive and be very additive on top of the underlying movement of the stock. Again, it's, you know, it's all in the characteristic of the way that the chart looks and the way that the stock behaves from a day-to-day basis on its change.
Yeah, for sure, for sure. And just again, for people who are kind of new to the perfect portfolio, we don't just hold one position. We hold multiple positions, and then we rebalance the portfolios, right? So we don't really get the performance that you would see on like a tool like Portfolio Visualizer, because we're really buying the ones that are down and essentially rebalancing them. So again, it's the tools you also put behind it. And you know, so anyways, again, and we use buy board eye, so we reinvest all the dividends. So if you look at those things, I guess this is a good transition to what you guys are building there with the YMAX. I saw the YMAX come in. I was like, oh, that is a great strategy, because I understand it. If you combine those things, just the analysis I did on the funds, you know, you may get a Coinbase that's just hammering it up. You may get some that are having NAV erosion, but then you're having some that are beating those stock positions. Is that where the YMAX came from? Tell us a little bit about who sat down and said, this is what we got to do. Was it
Actually, this strategy itself really came from our investors, right? We got a lot of feedback. And what this fund is, a brief description is this is a fund of the Yield Max funds. So we take the 18 Yield Max funds that are out there, put them into a single fund package that creates natural diversification, aggregates the yield across the universe of the Yield Max ETFs. And the concept came from, hey, I'd like to buy these and I'm doing the reinvestment. Like, can't you guys, I don't want to take single stock risk. I don't want to take Elon Musk risk. I don't want to take Jeff Bezos risk. I don't want to take, whatever. We can think of the names associated, the Zuckerberg risk, right? So you'd much rather have some diversification. If you're in Yield Max, it really is all about getting that yield, right? And reinvesting that yield, which I would consider alternative growth. Well, this makes it easier in a one-stop tool to kind of combine what's going on in the Yield Max funds into one single tickers, right? So that's a fund of funds. Now, doesn't mean you can't sprinkle in a little extra CONY if you like CONY, Mark. It doesn't mean you can't sprinkle in a little extra AMD and NVDY because you think the semis are going to do well. But we built the YMAX based off of actually investor requests, right? It was not on like the original list of strategies we put out. But once, Yield Max started rolling, we're like, hey, people are really asking for just like a fund to fund on this. And so it's now live, I think, a total of 5 days. Today's, January 23rd. So it is just new coming out, but so far seems like the market, it's being well received with a decent amount of volume and money flowing in.
Yeah. So tell us how that works. Did they take all the Yield Max funds? Are they using Defiance in there or just the Yield Max? And then
yeah. So for YMAX, it's just the covered call Yield Max funds that exist, and there's a distinction why I said just the normal covered call, the synthetic long, with the covered call. It's just those. And so the way that a ticker, because we will continue to roll out new Yield Max single ticker ETFs. Once one of the newly launched ETF pays its dividend, we will then put that new dividend into the next monthly rebalance. So we are rebalancing the portfolio. And so, kind of changing the build. And as new ones come in, we will put it in there after they have their first dividend. So a year from now, if we launch 5 more or 10 more Yield Max ETFs, they'll find their way into the YMAX, universe, and they'll find their way into the fund of funds.
Okay, you just build them in there. And now you guys are sort of reinvesting the dividends and to rebalance the portfolio to buy the other ones, or are you actually selling them and then rebalancing the portfolio of YMAX?
So we will distribute the dividends that are brought in, right? So the same concept, right? You can, you will get the larger yield, right? So if they're equally, I don't want to, because we haven't had a yield yet, so I can't point to a number yet. But if you could do the math, it's pretty simple, right? If they're equally, allocated, and you take a look at the average yield across Yield Max, if it's 30 or 40%, that should be kind of an expected distribution rate. We will do the same thing. We will distribute the dividends. Actually, but the distribution date is 2 weeks after. I think it's a week after or 2 weeks after the single stock Yield Maxes. So, you'll kind of have a little bit of a delay. But when the underlying tickers pay Yield Max, YMAX, the dividend, it'll be held and then it'll be turned around and distributed back in the form of a dividend. So then, we would still re-encouraging dividend reinvestment with YMAX, right? Same reasons, right? You want to compound your shares. In your scenario, you want to use it to help pay some of the loans down, right? All of those things that you're doing in your portfolio.
Awesome. So, well, very cool. So, now as far as so you're not using QQQI in there, and maybe we can touch a little bit on that because I know you're the guy behind the scenes who's working on the portfolios with QQQI. I'm a big fan of QQI. I guess if you bring off the term, it's doing well. It's kicking off money. I mean, I'm making money with it. So, how's the QQQI thing? And again, we have such short period of time. Even Tesla's hasn't been around that long. Like it's just a little too new to look at it. But the QQQY, we also use that in our portfolios. How's that working? Is it working everything like you wanted it to?
Yeah. So yes, it is. And you're right. The Defiance ETF QQQY is not a single ticker and not even a basket. It is options on the NASDAQ 100, right? Daily options being sold to generate, the premium that we can find in one-day options. Look, I would say it is performing absolutely as expected. Similar to a covered call, the strategy sells in the money put. So believe it or not, if you're an options person that's ever drawn a P&L chart for a covered call and an in the money put, they look identical, right? Still capped on the upside, still take downside risk, but generating, the time decay. And the nice thing about those, we're not selling weekly options, we're selling daily options. And so we get to sell 20 options throughout the month and earn little bits of time decay each day. And the in the money portion allows me to capture some of the upside movement of the underlying, in this case, the NASDAQ 100. So yeah, look, the NASDAQ had a strong year last year. No doubt about it. I think the NASDAQ 100 was up, I think, close to 50%, if not over that. So you mentioned S&P at 24, NASDAQ 100 over 50. Very, very strong year, strongest year in decades. But the nice thing about QQQY is it'll capture some of those movements. It'll still be capped. You get a 3% day. QQQY is not going to make 3%. But guess what? We're in it the next day. It's not capped for a month. You mentioned QYLD. That is more of a, regimented, here it is, cookie cutter. We get into a position at option expiration and we hold it to the next month, and that's it at the money options. Not a lot of upside. With QQY, we're capturing upside movement and then lots of little bites at the apple of selling option income each day. So we've also been happy with the performance of QQQY. We think it's a nice, focused alternative income play as well, where it's just pure option premium. A little more than others. Its distribution rate is obviously, fairly high, ranging from the 50 to 60%. So again, there's just a lot of option premium in those daily options. And you said, it's been fairly well received. The answer is it has been. It's been live since the end of September. So we really only got 3.5 months under our belt. And that complex with Defiance has raised, close to 500 million. So it's absolutely being well received in the marketplace as well. Just like YMAX.
Yeah, for sure. Yeah, I personally own a lot of the fund. JAP Y. So obviously, I used to own JAP E, JAP I, and then JAP Y, and of course, JAP Y is far outperforming JAP E, which I think that was the intention there. But it's amazing how much
it might have been.
Might have been. I'm not saying you did. I'm not saying you ever heard of JAP E before you launched JAP Y, but it was just, I'm just letting you know, reporting back to you that I was very happy to replace my JAP E with JAP Y. Anyways,
thank you.
We're always innovating. We're always disrupting at the perfect portfolio. I mean, the last thing I want to do is just, do what I used to do and just say, hey, sell a mutual fund and then hopefully people get to retirement. That's not I've never been excited about that. I know you like to innovate as much as possible. What is new on the horizon? Anything that you're like excited? I was talking with a mutual Mike who at Zega, and we're like, man, here's what if you took a fund that was, and by the way, I do this in my own portfolios. I took the stocks and then the synthetics, and I put them beside each other, and then we put a rebalancing feature. And that's awesome, because if Tesla drops, it'll take all the dividends and buy more Tesla of the stock. So it's just a money machine in there. And it's consistent with buy, borrow, die, because obviously some positions we never want to sell them, which could cause taxes. So I don't know if you're throwing out an idea there, I don't know, maybe we'll see if there's comments like, wow, that would be cool, because I do use it. I built it myself, and I have some of our students using it. So, that could be like a hybrid, maybe, where down the pipeline for you guys. So just, but anyways, what are you building right now? What are you excited about? What's coming?
Yeah, there's two funds that, while I can't say too much about them yet, they have been filed, but we should see them, within the next few weeks. The first one is another Defiance fund, TRES. It is a treasury-based fund where we're running an option strategy over the top of that. And then another one is our ULTY, which is our YieldMax Ultra portfolio, which essentially is a basket of securities where we are selling, the covered calls, whether we're using the synthetic or we're using the actual stock. We'll select securities, analyzing things like the implied volatility, the option volume, the prices on the options, all of those types of things. And we'll build a basket of those. So we won't be tied to a single underlying ticker. It'll be a basket that goes through kind of a screening process. So we're excited about those two funds. One will be a little more muted, more treasury based, and the other one with a ticker ULTY, Ulti. I think you can get an idea that that one might be, interesting in the yield max world without getting into too much of the philosophy behind it at this point. But those are both filed, so more things to come at Zega.
Wow. So you guys are looking at, correct me if I'm wrong here, is that you guys are basically if you look at all those different stocks in the yield max, you can rotate which ones you see the biggest opportunity within the fund. Is that what you're saying?
And it doesn't even need to be restricted to the stocks. I think we gave ourselves in the prospectus the choice of really any U.S. stock, any U.S. ETF, and an ADR. So we gave ourselves a much wider universe than just the 18 tickers. But you're right.
Okay.
Like you see this in like NVIDIA today, right? Or you see it in Coin, or you see it in Netflix, which has earnings, I think, tonight or tomorrow night. You'll see more premium as you're going into earnings. Well, wouldn't it be great to be able to rotate through the ones that have higher yield based on what's going on their normal calendar? So things like that kind of come into play in that. Again, I probably said too much, but it's all about, the screening process, and the universe of stocks is not limited.
Awesome. All right. Well, cool. Well, good. On that note, I'm very excited about that because I understand what the potential is for that to like pick and choose the opportunities. Of course, I don't want to do that. I mean, I can't imagine the analysis that you guys do to do this stuff. But anyways, thank you for being an innovator. Thank you for being disruptive. I resigned from the financial industry in 2018 because I was like, man, we can't really disrupt or innovate. And then I found you guys. So it's been a fun. Our students love Zega Financial, by the way. Some of our students are clients also of Zega Financial, so we're loving it over there. But anyways, I'm looking forward to these new funds. Last comment. There's a tick that there's obviously treasuries, sell options. There's the VIX, SVOL. Are you guys playing with the volatility index options on it like that, or anything like that, or gold? I mean, people comment, are you taking gold and then selling it because people want exposure to gold? Anything like that, or can't comment?
I think all those things are in our little our laboratory, right? So I got a bad scientist who's testing away ideas like this. But sure, of course, absolutely right. You want to look for. I feel like we've really just started scratching the surface on options-based ETFs. They've been around for a long time, but we've really seen some momentum, and so of course we want to explore those items. The VIX is always a fun one to talk about. It's had its ups and downs. There've been some disaster stories with VIX-based funds, so it's all stuff that we learn from. But it is really a beast unto itself, which as an options guy is great, right? So there's always an opportunity there for us to put something out.
Awesome. Well, very, very cool. Well, good. I get ready to catch up with you again. And I guess last but not least, for the people that watch our channel, I was an investment advisor for 14 years. And one thing they teach you in the investment advisor world is you have this thing called the 4% rule, right? And we're all familiar with the 4% rule, which says, hey, you can retire on 4% of your income from your retirement account. So if you take a 65-year-old and they have $1 million, you get $40,000 a year to retire on that. And when I really sat down, I'm like, is this really an industry that I want to be by? But by the way, they amended that to 3.3%. So if we can beat 3.3%, out of these funds, we're doing better than the entire industry and just an index fund. So anyways, like I said, we all want to kick back and sit on the beach and collect huge amounts of tax-free income. So if you can just go solve that for us, that'd be great. Well, and we can all just do that. How about that, Jay?
That's your bailiwick, my friend. You're the expert in the tax-free income world.
We're working on it. All right, cool. Awesome to have you on again. Have a great day. I know you're busy. You're probably just ringing the bell and then going to create another fund and then ringing the bell on the stock exchange. Is that what you do?
That's all I do. Just ring New York Stock Exchange bells. That's fine. Anyway, thanks so much for having me on. I always love the conversations, Mark.
All right, cool. Bye for now.